All right, today we're jumping right into a really tricky question. How do you handle a bull market that feels like it's about to fall off a tightrope?
So I want you to put yourself in an analyst's shoes for a minute. The market? It's hitting all-time highs. On the surface, everything looks fantastic, but you're seeing cracks in the foundation. The biggest players, the institutions, they're quietly selling off their positions. The data is all over the place. What on earth do you do?
We're going to break this all down by looking at a single, really paradoxical day in the market, September 9th, 2025, a day that was pretty much the definition of a fragile bull market.
Now, there's a fancy term for this, a transitional risk-on regime. I know, it's a mouthful, but all it really means is that the market is stuck in this massive tug-of-war between greed and fear. You know, it wants to sprint ahead, but it feels like it's walking on eggshells.
And here is that conflict, clear as day. The bull case looks solid, right? The VIX, the fear gauge, is super low, momentum is positive, but then you look at the bear case, and the smart money, we're talking large institutions, was selling like crazy. And individual investors, surprisingly bearish. It's a complete and total contradiction.
So, on that morning, the VIX clocked in at 15.18. In theory, that means there's almost zero fear in the market. But, for a seasoned analyst, a number that low can actually be a huge warning sign. It can be the quiet before the storm.
Okay, so let's dig into the evidence, starting with our first key player, the S&P 500 ETF, or SPY. Let's think of it as the market anchor. Its stability, or lack thereof, really sets the tone for everything else.
But here's the thing. This anchor isn't stable at all. It's stuck. The price is coiled up like a compressed spring right underneath this massive resistance wall at $650. The entire market is sitting at a critical tipping point.
So, for an analyst, the game plan for SPY becomes really simple, almost binary. The bias is weakly bullish, but super fragile. If it can break above 650 and stay there, that's the bull trigger. But if it gets rejected and falls below 647.20, the plan immediately flips. The lines in the sand are drawn.
But there's a hidden force at play here, something happening behind the scenes in the options market. The analysis noted that dealers were short gamma right in this exact price zone. So, what does that actually mean for the rest of us?
Well, it creates this incredibly powerful feedback loop. It means that if SPY does break above that $650 level, the very dealers who sold options against it will be forced to buy stock to cover their own risk. And all that forced buying, it's like pouring gasoline on a fire, pushing the price up way faster than anyone expects. Okay, on to our second character in this drama, Tesla. We'll call it the volatility amplifier. Because if SPY is the anchor trying to hold things steady, TSLA is famous for making these huge, explosive moves that can shake everything up.
And on this particular day, TSLA was stuck in what's called a Bollinger Squeeze. The best way to picture this is like pinching a garden hose. The pressure just builds and builds and builds in the super tight range. All that energy has to go somewhere, right? It's a classic signal that a massive move is coming. The only question is, which way?
And for TSLA, the signals were even more jumbled than for SPY. The overall bias was neutral, but it had this slight downside lean. And why is that? Well, while the chart looked ready to explode upwards, institutional investors had just flipped from being net buyers to net sellers. So the triggers were clear. A big move up needed to break $355, but a break below $338 could start a really sharp sell-off.
And that brings us to the final piece of our puzzle, the real wild card in this whole fragile market, Bitcoin. For our story, we're going to call it the crypto gatekeeper. It's the gatekeeper because as a key barometer for risk-taking, its next move could either unlock a massive, market-wide rally, or it could slam the gate shut and send everyone running for safety. And just like our other assets, it was also coiled up tight at a huge psychological level.
And here, the short-term bias was actually leaning bearish. Yeah, even though big institutions were showing long-term interest, the technicals in the short-term order flow were pointing down. A breakout would need a really strong push, while a drop below key levels would likely trigger a defensive, risk-off move.
But Bitcoin had this one unique advantage. Its options were historically cheap. We're talking first percentile cheap. This created what traders call a convexity play. It's kind of like buying a lottery ticket that has a really high chance of winning something. You just don't know if it's the jackpot or a smaller prize. It's a low-cost way to bet on a huge move, no matter which direction it goes.
So there you have it. The market anchor is at a tipping point. The volatility amplifier is coiled and ready to explode, and the crypto gatekeeper is leaning bearish but is primed for a massive move. How on earth do you build a coherent plan out of all these conflicting signals?
Well, the answer starts with a balanced, really strategic allocation. The plan called for 40% in SPY as the stable core, 25% in TSLA for that high-risk, high-reward potential, and interestingly, a big 35% chunk in the Bitcoin ETF, seeing it not just as a volatile asset, but as a potential leading indicator for the entire market.
And this, right here, is the most important part of the entire strategy. It's not about predicting the future, it's about having bulletproof risk management. The plan laid out strict, non-negotiable rules. Limit your options risk, use automatic stop losses, and have a kill switch. If the VIX suddenly spikes above 18, a full-on defensive plan kicks in immediately, no questions asked.
Ultimately, the really new idea to come out of this analysis was this potential link between the assets. The theory was that Bitcoin's behavior could actually be a leading indicator for the rest of the market. This suggests that Bitcoin wasn't just a wild card, it might have been the canary in the coal mine. Which leaves us with one final big question to think about. When you're facing so much uncertainty and so many conflicting signals, is the goal really to predict the future correctly? Or is it to build a robust plan that can profit from a breakout, but also survive a breakdown? Maybe in a fragile market, being prepared is just way more important than being right.